Welcome into the three-piece, folks. I hope everybody's doing phenomenal. As always, 3 videos for me to react to up here today. First one up here, Sanchez. Markets will likely be volatile today as many safe haven trades are already in play. Want to hear what this woman has to say in regards to this, share my opinions and perspectives in regards to that one. Then we're here, Mohammed El-Erian, a very well-respected man in the financial markets. Want to hear what he has to say in regards to this Middle East situation. Is this a big deal for the stock market moving forward? Is this something that could crash the market? How could it get a lot worse? All those sorts of things. So want to hear what he has to say. I think it's very important. And obviously I want to share my opinions and perspectives as well in that one. And then last video I want to react to here is you'll see a break in yields once you have a meaningful slowdown in the economy. So I think that's an important subject we got to speak about here. And I want to share my opinions and perspectives, which, by the way, this week does mark the beginning of earnings season. PepsiCo, you got WBA reporting this week, Fastnell, obviously Domino's, Delta, and then you got a bunch of the big dog banks all reporting Friday. So it's here, folks. It is actually here. Earnings season here. Appreciate everybody joining me as always. Thank you so much for being here, folks. 35,000 plus subscribers now. Appreciate every single person for being here and being subscribed. And let's get into this.
Day since the attack over the weekend, as we mentioned, we've seen moves to safe haven plays like gold, the dollar, and other global currencies. What are you expecting for the markets in the near term, specifically today?
So I think we're going to get a lot of volatility. Some of the safe haven plays feed into rallies that are already in place. So you look at the dollar. Dollar's been rallying for a couple of months now, and that is pretty long in the tooth. So we don't know how long that rally will go. Gold, on the other hand, has actually been down since May, since, you saw inflation really turn the corner and start a downtrend. So that rally could actually, go for a bit longer, depending on what happens. Treasuries is going to be interesting because treasuries were in the midst of basically normalizing, having the yield curve normalize. So we're going to have to see what happens there. And a lot is going to depend on how the Fed reacts and how prolonged the oil pain is and whether...
By the way, folks, if you didn't know, today, literally today, the bond market is closed. So we don't have to deal with that drama show, at least today. We will starting tomorrow, though.
That feeds into the Fed calculus.
So these attacks over the weekend, obviously very unexpected, but certainly there are global conflicts that a manager like yourself have to plan for. Right. Does this fall in line with the historical precedents of other conflicts, or do you see this as something different, maybe an outlier when it comes to its impact on the markets?
Well, so what we normally see when you see a war declared is the first question we ask is, does it affect commodity prices? If it affects commodity prices, often you'll get a really, really quick downdraft, and then within 6 months prices go back. However, that doesn't hold when interest rates are rising. Now, before 2 years ago, we only had one observation of that, which was the Yom Kippur War. Then Ukraine came and basically furthered that. So yes, every time you have rising interest rates at the same time you have oil prices high, that's not a good recipe. It was a terrible year for the markets.
Yeah, and the problem is when it came to Russia, Ukraine, I mean, you're talking about 2 massive players in the commodities market. Not small players, massive players in the commodities market in general. So obviously what's going on with Russia, Ukraine was very detrimental to the commodities market overall, at least last year. Now it's starting to not be as impactful, but it was definitely a huge scare last year.
Could be the same. We could be sort of setting up for the same kind of setup. So it really depends on what Powell does.
All right, so this could possibly be the third, you're saying?
Yes.
The Yom Kippur War and then the Ukraine War, and now this one potentially.
Right.
Okay, something we certainly have to watch. You're mentioning rising yields. Specifically this week, we're talking about rising yields on the 10-year, the possibility of it hitting 5%. Does this conflict, do you think this will lead more investors to go to safe haven assets and maybe lead to yields declining?
So there's 2 ways you could get there. One is the safe haven trade. So you already see money flowing into dollar. The dollar is already rallying. So you're also seeing flows into treasuries. And that will depress the 10-year. Now, the question is, what does the Fed do about this? If in fact we see real oil supply disruption, and that would really come on the back of what happens with Iran. If we discover that Iran is behind the attacks, we could see real oil supply disruption, and that could actually lead the Fed to either pause or even cut. That could make a difference.
Interesting. Okay. Yeah, I'm really looking forward to getting into Mohammed's opinion here in regards to this. Okay. Before we get into what kind of Mohammed says here, just give my intake on this whole situation, okay, and what it actually means for the markets. I don't think it means a ton for the markets past probably this week. And I'm really interested to hear what Mohammed has to say. Why do I feel like that? We're dealing with the Middle East. The Middle East, there's been problems in the Middle East for freaking a long damn time, okay? Probably actually a lot longer than the stock market's been around, okay? Like, that's just something you got to deal with. Like, the Middle East has always been a problem. It always will be a problem. There's always going to be so many conflicts between those countries over there. And I don't see that changing. And so the market's just gotten used to that over time, I feel like. We know that's going to happen. We know there's going to be problems. It is what it is. And we'll sort through it and we'll get through it. And then hopefully that will come to a close. But there's going to be more problems in the Middle East over time. I can just tell you that. It's, I wish there was peace in the Middle East and that was it. But that's just a little fairy tale, okay? All right, let's get into what Mohammed has to say here.
Attention to the events in the Middle East. And joining us right now is Mohammed El-Erian. He is Gramercy and Allianz advisor and president of Queen's College, Cambridge. And Mohammed, last week after the jobs report, you said that a soft landing was much less likely, that there's a risk of something breaking. How do you now assess everything with this added on top of it?
So, Becky, given what's happened over the weekend, and my thoughts and prayers are with the families and friends of those who lost loved ones and all the other innocent people who are either missing or have been taken hostage. Look, this makes the U.S. outlook even more difficult. I think the key question, and you've got some really good guests coming up, is this conflict contained or does it bring in other parties? So far, the markets are trading as if it's contained. But if this expands and brings in other parties, then the outlook is for even a weaker global economy, even more inflationary pressures, and the markets are going to be finding it hard to deal with that.
Look, there's the idea that's been not 100% confirmed at this point, but a very likely idea that we've already got Iranian involvement with this. So if Israel retaliates against the Iranians, is that what you're talking about by expanding?
So you can see a scenario, and again, you have other people who can speak with more authority, a scenario in which Israel retaliates against Iran, Iran gets engaged, Syria and Lebanon start being an much more active front. It's active now, but much more active. And then you've got a significant war going on. And then ask the question, what's going to happen with Ukraine at this point and Russia? What's going to happen with China? So this is why the big question for the markets and for the economy is whether you get escalation. If you look at the way we're trading right now, it is a somewhat higher risk of escalation, but not significant. And that's the major call.
It doesn't even feel much like that. I mean, 150 points down in the Dow, you can walk on any given morning and see.
Correct. And only 4% oil up. If you look at government bonds around the world, yields haven't come down in any meaningful manner. So the market is treating this as a contained issue. And I think that's the major question that has to be debated. Does it remain?
So why is the market not down, 1,000 points or whatever in this situation? I can tell you exactly why, okay? You're going to understand market participants and what we've been through over the past many years, okay? We went through a once in 100 year, obviously, health event in which all of a sudden, suddenly, out of nowhere, we are closing the global economy and people thought, things were going to be closed for the next 3 years. And we all thought businesses are going to go bankrupt and even the largest companies in the world are going to go bankrupt and we're going to have the Great Depression and all these sorts of things. Yeah, we went through that, right? Like, that's already a huge event to deal with. You had to deal with, obviously, Russia-Ukraine, which was on a global scale, a much more talked about and scary situation than certainly the one we got going on as of right now in the Middle East, right? So we've been through some trauma, right? The highest inflation since the 1970s, right? We've gone through that recently. The markets had to deal with so much trauma that it's begun to get a little immune to these dramatic situations, right? And so this happening, the market's like, compared to Rona, this is nothing. Compared to the inflation we've been dealing with, this is nothing. Compared to Russia, Ukraine, and what that meant for the markets, this is nothing. That's the way the market starts to view these things, right? And so, it's just, when you've been through a lot of trauma and you've seen so much, and especially recently, because we're just talking in the last few years, you start to become immune to these sorts of things. And it's like, it needs to be something crazy to even get your attention, to really like be like, oh crap, I got to sell on my portfolio today.
Contained.
What would you advise? What would you do in the markets today? It sounds like you think there should be a higher premium built into this.
If you step back, we are every day facing more and more uncertainties. And this is what you get when you have geopolitical tensions. This is what you get when growth is insufficient. And this is what you get when you get policy mistakes. So yes, we are on this road where we seem to get crises. You know, Andrew and I were at an event where we talked about geopolitical issues. That issue wasn't even mentioned. And this was a couple of weeks ago. And you had geopolitical experts, and it wasn't even mentioned. So, you know, it's another unthinkable that has become reality.
Just in terms of how you would be looking at this, some people have pointed back to the 1973 Yom Kippur War. Other people look at this and say, okay, you're running into trouble from maybe not great financial crisis levels of things, but the idea that things break. I mean, that's what you were talking about last week. What do you look out and think could potentially break?
So last week when I was talking about this is because you had the combination of three things. You had a significant move up in yields. Since the end of the second quarter, the 10-year had moved up 100 basis points. That is a significant move. You had a significant move up in oil, and you had a significant move up in the dollar. Historically, those three things happening break something. They tend to break something in the financial system. And the market concern is that we haven't even finished with interest rate risk, and then there's credit and liquidity risk there. So that was the issue, is pay attention to what has happened over the last few months, because historically, that is not a great combination for the economy or for the markets.
You talk about policy.
You know, it's really almost startling how much this time period we've been going through recently has reminded me really of 2002, 2003, 2004, okay? And like on so many different fronts, it's crazy. Obviously, you had a little bit of higher inflation in some of those years, but you didn't really have it, especially like 2000, 2001, but you didn't have it obviously as high as we've dealt with recently. So, but you were in a little bit of higher inflation. You did deal with a market where rates actually started to go up quite a bit, and that's part of the reason that tech stocks fell so heavily in around 2000, 2001 into 2002. And what did we see over the past, couple of years? Well, valuations come down in a massive way. We saw the tech stock crash last year where some of the greatest tech stocks in the world fell 40, 50, 60, 70%, right? You obviously saw everything that happened in crypto last year and what a disaster mess that was. And then you add on top of that, now we're getting into all these different conflicts. What does this remind you of? This reminds you kind of 2002, 2003, United States, Iraq, Afghanistan. Difference is obviously we went into those countries, we sent our soldiers in, right? Versus now we're like providing ammunition and we're providing all these weapons and things like that. So we're not actually getting involved from terms of like sending boots on the ground, but we are still getting very involved in several different conflicts. Now we're involved in Russia, Ukraine. Now we're going to be involved in this, right? In terms of the United States, damn, it's starting to remind me a lot of that time period, right? A lot of that time period. So which makes me think, are we going into kind of like a 2005, 2006 type time period where, everybody's expecting this big crash, maybe we don't get it, and eventually it's going to come a few years from now, but it's not here yet, right? And so I don't know, man, it is startling like how much this is reminding me when you really start to play it out and you understand what was going on in 2000, 2001, 2002, 2003. Man, there's a lot of like just reminders of like this is very similar to back at that time period.
You mean the Fed continuing to raise rates potentially or keep them higher for longer?
You've heard, I think the Fed has done enough, but this assumes that you're willing to acknowledge what I think is true, which is we live in a world of inflexible supply, and the Fed has to get used to the notion that 2% inflation is not the right target to get to quickly.
Mohammed, I think everyone...
Even like the mortgage rate buy-downs, I'm sure you guys have heard about the mortgage rate buy-downs that are basically going on where, you go to a home builder or whoever and basically you do this mortgage rate buy down. I think even a lot of these, financing companies are starting to do it, and it's becoming more popular, and that's something that's going to scare me in a few years from now. I can tell you that much. It doesn't scare you today, but it's going to scare you over the next few years. A lot of people are doing these mortgage rate buy downs, right? which at the end of the day, it feels a lot like the adjustable mortgage rate loans they were doing back prior to the great financial crisis, where all of a sudden it's like, oh, your payment's so much lower for this next year, this next 2 years, but year 3, year 4, your rates are going to adjust, and everybody's figuring rates are going to go down, and we'll see, maybe they do, but if they don't, all of a sudden your payment's going to go up substantially. It reminds me a lot of the balloon mortgage payments that we were starting to do prior to the great financial crisis, and just one of the other reasons we ended up having the great financial crisis, because all of a sudden people had to start paying way much bigger mortgages. People couldn't afford those. It's scary how many things are reminding me of the time period we had a few years before the GFC, man. It's crazy how many things are starting to go on that it's like, oh my gosh, you got this, you got this, you got this, you got this. Whew.
Just had a viewpoint that the Middle East had been, I don't know, it wasn't settled, but it seemed a lot more stable. And I know just last week, one of the presidents, Jake Sullivan was saying it's been decades since
quieter there than ever.
So now I can only imagine how the feeling of Israelis at this point must be just, they are just beyond furious, and just they want it. There's going to be, we heard Netanyahu say there's going to be a retaliation like you've never seen. We already know that Palestinians, I don't know whether we thought that was being somehow settled, which it never really was, I guess. But if there's really a lot of carnage in Gaza, which I think we're expecting, this whole thing, we are back to square one on this whole thing. The whole world looks a little different and much more. I think the Middle East is going to be what we've always viewed it as, back to just a complete powder keg. And then you throw in nuclear capabilities with Iran. It seems like the whole world changed over the weekend.
I hope we're not back to square one, because Israel has peace treaties with a number of Arab countries, which they didn't have in 1970.
Yeah, I agree. He definitely went a little far there, back to square one. I wouldn't put it that way yet, okay? It's possible it could get there. But yeah, we're not back there yet. Like, let's not, go too crazy with this.
But the mistake we all made is that we marginalized the Palestinian-Israeli issue. We assumed that this is all about Israel and other countries. So the Abraham Accords, what happened between Israel and Saudi Arabia, and we marginalized the Palestinian issue, and now the Palestinian issue has imposed itself. This is going to be awful because, understandably, Israel is going to go after Gaza. Gaza, as you all...
That's going to just infuriate. And whatever grievances long held the Palestinians, that's just going to be exponentially worse.
Right? It is, and there's going to be a lot of innocent people dying. And those images are going to go around the world. And
each one of them, will scarred for the rest of their life remembering this was because of Israel. And then Israel saying this is because... And it's just, the vicious cycle is going to repeat itself.
That's why, and if you will be talking to people, they'll say that ultimately the question is, can you get a just and comprehensive peace there or not? Otherwise, this cycle will repeat itself. It's 50 years since the 73 war. It's exactly 50 years since the 73 war.
Yeah, 100%. There's no good that comes out of that, man. Just sad situation all around. But in terms of the market, you can't get too crazy about all this stuff yet. We'll see how it all plays out. We'll see, what the impacts are in the market. Obviously, the oil market. In order for it to really impact the oil market in a substantial way, more than just whatever happens this week, you're going to need a lot more problems in the Middle East. I mean, a lot more problems. If you can get a lot more problems in the Middle East, and you can get more countries involved, and you can get this level of seriousness amped up substantially from here, then you could actually have oil price starting to skyrocket to $100, $120, $140, because we obviously know how important the Middle East is when it comes to oil markets. Substantial, right? Alrighty, next one up here. Let's get into this one. You'll see a break in yields once you have a meaningful slowdown in the economy.
Chief Investment Strategist, Anastasia.
Oh, by the way, United Health is the biggest stock in the Dow. I forgot. They're reporting on Friday as well.
Rosso and Subhadra Rajappa, head of U.S. Rate Strategy, Societe Generale. Both of you have a feel for equities, even though we're talking fixed income at this point. So I want to start with you, though, Anastasia. This is disturbing or at least unsettling for stock market investors. And in the past, things like this We've already had a little bit of a correction. It could be an indication of something worse, in your view, for stock market?
Well, I think the stock market is clearly going to focus on the events in Israel over the weekend. Right. And, first of all, it is saddening to see the human toll. It is extremely sad. And then, second, from the perspective of the stock market, it is a geopolitical flashpoint that, we have to kind of process how this might escalate and how might this be contained. And, clearly, I think what's already playing out is what's happening, the conflict that's happening in Israel could further fracture the fractured world that we have. And a lot of countries around the world don't see eye to eye on this. And by the way, of course, Iran and what happens to the Iranian barrels and whether oil is going to become a geopolitical bargaining chip, that's really what's at stake here. So we don't exactly know how this is going to shake out. But I think, Joe, you're right that it adds to a lot of uncertainties that the markets have been grappling with. If I were to kind of take this other side of that, and given the pullback that we have seen, one area within the market that's really not that tied to oil, for example, is technology. So I think that's why investors have been stepping in and trying to buy the pullback in technology, because you don't have the oil sensitivity, you don't have some of the geopolitics in there. So I would suspect that that's where investors will be looking for opportunities.
So, Badra, we've been in a sustained uptrend in yields, and we're hearing higher for longer. I think the first time we heard that was probably 6 months ago. Only in the last month, they must have said it like a lot more convincingly, because suddenly we believe it, and I think it's happened. But you think we could get a pause in the upward move in rates right now?
Absolutely. In an environment like this where geopolitics takes over, like Anastasia was talking about, higher oil prices is a big concern for the bond markets. My concern is that if this sort of environment persists and, the geopolitical risks, start to weigh on the markets, then we could be looking towards perhaps a more stagflationary environment. And this is more pronounced in Europe and UK, where inflation is a lot higher than it is in the US. But the US as well, you're going to see, if gas prices start to go up, you're going to see consumers coming under pressure. So this might, I would say, dampen the momentum towards higher yields. We've seen a very precipitous rise in yields. The flight to safety, if you will bring investors to treasuries and cap the rise in yields at current levels.
So yeah, and in terms of Tesla and how does this whole affect Tesla, it could have ramifications for Tesla as well. Okay, at the end of the day, people have already been hit by gas prices 2 straight years, right? They got hit in summer of last year. They're being hit again over the last several months in regards to gas prices, right? If you were to talk about this Middle East thing gets out of hand, next thing you know, oil's $100 plus a barrel, and then 120, 130, whatever. Oh boy, okay. It's just going to add more ramifications in terms of people turning to EVs for the next vehicle. Because, you can't have people get hit 3 straight years for oil prices. Like 2's already ingrained into people's minds about gas prices and how bad these gas prices suck. If you hit them 3 years in a row, oh my gosh, okay. Internal combustion engine vehicle days are long gone.
May not see 5%. Anytime soon then on the 10-year? You think it's a pause? I mean, that's only 20 basis, whatever. It's not a lot, but we may not see 5.5 or any of the worst case scenarios, at least near term.
It definitely seems that way, given the fact that we've moved a lot already. To me, a lot of that move is not fundamental, but much more technical. Under those circumstances, I think that you're going to perhaps see a little bit of a slowdown in the momentum towards higher yields. But it really depends on how quickly this issue gets resolved. Broadly speaking, the economy is on a very strong footing coming out of the third quarter. The jobs report that we got on Friday was very strong.
By the way, let's not confuse this. Who's making all this dang money from oil? Let's say oil prices shoot up a bunch more. I don't know, instead of $80 a barrel, it's $100 a barrel, 120, whatever, right? Russia is going to make a bunch of money. The Middle East in general is going to make a lot of money, especially all the big oil producers in the Middle East. So they kind of got to love it, because at the end of the day, their cost to drill a barrel, get a barrel of oil out of the ground, it's not going to change. If they can get a lot more for that barrel of oil, it's all pure profit. It's all pure profit, man. And I'm sure you guys have seen some of the studies that have been done in the past around how much it actually takes to produce a barrel of oil in many parts of the Middle East. And I've seen estimates anywhere between, some countries, $3, $4 a barrel of cost. And so anything past like $5 is just profit. And I've seen somewhere it's like $15, $17, things like that. So anything past, $17, $20 is pure profit. So every bit you go above that is just more profits coming in, right? In a massive, epic way. So, just keep in mind all that money you have to pay extra at the gas station if you're driving an internal combustion engine. The money's going somewhere. And it's going to some big players' pockets. It could help out the big oil producers as well, the Exxon Mobils and the Chevrons and all those guys. But just keep in mind, there's certain countries that are going to be making bank if oil prices shoot higher because of this conflict.
Labor markets are very, very tight. So I think that could perhaps, keep this, yields around these levels between 4.5% and 5%. But ultimately, I think you're going to see a break in the yields if we start seeing a meaningful slowdown in the economy.
So, Anastasia, you started touching on tech. So you think that people are going to use any weakness as a way to add to positions, regardless of what happens?
I do think so. I mean, case in point, Joe, last week, you've got the 10-year breaking out and reaching 4.8%. And you know what the top performing sector of the S&P was? It's software. So it's really definitely seems like people are using the spikes in yields to buy the dips in technology. And I'm sympathetic to the point that I think yields can pause around current levels because we're coming out of it.
Is she Canadian? Like, there's some sort of accent there, man. I'm trying to figure out what it is.
Extremely strong third quarter, but we're not going to have 5% GDP growth in the fourth quarter. Not with the auto strikes, we're not with a conflict in Israel. So I think growth is going to slow down pretty meaningfully, but not be negative. So that could put a dampener on the yield move higher. Then inflation, I think the markets really reacted to oil prices rising. And of course, they're rising this morning. But at the same time, energy is about 7% of the CPI basket. I don't think the Fed is going
to Romanian
react to that. And we've got CPI on deck for this week, which, maybe rises a little bit month over month, but not as much as it did last month. So I think that's going to be constructive for the markets as well.
The Fed looks at core, obviously. It strips out some of those things. But eventually, energy prices work their way into everything, not just the hit that it takes on consumers at the gas pump.
Yeah, eventually they do. Eventually they do because, of course, it is a feedstock to a lot of the different products. But, if you look at the numbers, for example, for a 10% move higher in oil prices, we expect a 0.2% move higher in headline inflation and 0.1 in core inflation. So it does have an impact. And of course, oil prices at one point did move 20%. It does feed through, but not to the extent that I think would derail the entire story. But looking to Friday, we're looking to later this week, we've got inflation that we're expecting to come in at 4.2% on the core number. And I think that's a step down, and that should be favorable for the Fed. So I think pause in yields, as we talked about, would bring some of the investors back to those technology stocks.
And Subhadra,
as you might say, oil price got to be the play, right? Buy oil stocks, buy maybe USO, something like that. You might think that this could be easy money short term. My opinion that is, I wouldn't call it such easy money. Okay, one is if this doesn't develop into something much more substantial, oil price will start to weaken as you don't get anything really happening there. And we're once you get closer and closer to winter time, usually you'll see weakness in oil just in general, right? The other thing you got to factor in is the higher oil price goes, the higher gas prices go. The higher gas prices go, the more likely the economy is going to get hurt more and more and more, right? And then you push into more recession possibility. If you're pushing into more recession possibility, you're going to hurt oil price, right? Because if there's any sort of recession possibility, that's not good. That's not bullish for oil overall, right? I wouldn't call it nearly as easy money as I think some people are thinking it is.
And I guess we keep being brought back to reality at how dangerous it can be. But then, even with Ukraine, as time goes...
How dangerous can be? Have you ever been to the United States, man? We got people killing people all the time here. These people should have grew up in my neighborhood, man. There's shootings every freaking day. Like, come on.
It sort of goes into... I assume something will happen the same way here, and people get back to business, which is difficult, but it will be impacting economic activity in...
Go to Chicago. You'll see what the Middle East is like.
And oil, and so you can't really ignore any of these.
You just got to go to the right neighborhoods. You go to the right neighborhoods, you see all the action you ever want to see. You realize there's a war zone going on in America. Just we act like it doesn't go on because it doesn't happen in our neighborhood.
Oh, absolutely not. That's why we're paying hyper attention. And a lot of this data becomes much more consequential towards the end of a cycle like we are right now, where the market and the economy is much more sensitive to erratic moves in either the bond market or the commodity market, because that's going to put a lot of pressure. This has been building for a long time. Fed policy works with long and variable lags, and you're starting to see some of those lags feed through the economy. And then you get these geopolitical risks that could, if anything, hasten the timing for a recession sooner than what people anticipate. So there's a lot we're watching on, but I think that the rise in bond yields as well as rise in commodity prices has to have an impact on the economy.
Oh, 100%, 100%. Okay. So moral of the story is, in regards to this whole situation, don't go too crazy with it. We'll see how things develop. We'll see what impact it has in the oil market. You're not going to get any of those answers this week, by the way. Oil can spike higher this week just off of the thought of well, this could happen and this could happen and this could lead this country to do this and all those sorts of things. We'll see how it all actually plays out in reality, okay? And that will be determined over the next several months. Not just this week. That will be determined over the next several months if this is actually something that develops into something that, oh my gosh, this could cause a lot of drama for the markets and the oil markets, or this is maybe something that's a little limited. Appreciate everybody joining me as always. Thank you so much for being here for this three-piece here today, guys. 35,000 plus subscribers. I appreciate each and every one of you. I got free workshops for you guys down there that will be pinned comment. One is how I find 10x stocks workshop. That's about a 30-minute video. It's absolutely free to access that. And my other free workshop I have for you is investing foundations. If you're in your first 3 years of investing, that should help you out tremendously. That will be the pinned comment down there as well. Both those are absolutely free, so make sure you take advantage of those here today. Much love and have a great day.